How's it going, investors? I'm Ari and welcome back to my channel. Now, if you are brand new to the channel, well, a special welcome to you. It's your first episode here. Now, we had quite the week last week, experiencing a ton of momentum from built up excitement after earnings reports came in stronger than expected for multiple companies across indexes. However, I did share multiple times last week that this rallying would be short-lived, and we're in fact seeing that play out. Now it's time to double down on stocks that not only have the ability to survive market downturns on the horizon, but just deliver through on solid ROIs for their shareholders through the thick and thin of market mayhem. So in today's video, I want to give you a portfolio update, touch upon macro market overviews, and just leave you with 3 dividend stocks that I truly feel are worth your attention if they make sense for your portfolio than an investment. Now, before we get going, if you could do me a massive favor here, tapping on that thumbs up button, it helps me grow this channel and get that presence out there. And of course, if you haven't already subscribed, go ahead and tap on that subscribe button as well. I'd love for each and every one of you to be on this journey with me. Now, investors, let's get right to it. Right off the bat, if you are new to investing or you've been in the game for some time, yet you're just worried because you're watching your portfolio literally plummet, I want you to take some comfort in knowing that you are certainly not alone. And over the last few weeks, my personal portfolio has hit some lower lows that I haven't seen in a while, dropping by 10 to 12%, now sitting at $94,215.52. But I'm not sitting here with the case of the jitters. Why? Well, that answer is twofold. Number one, I understand the economic backdrop, and number two, my investments meet the criteria that deliver through on safety while also gifting me with returns regardless of the market conditions. So briefly, let's talk about the what and the why to explain all of this recent volatility. Last week, earnings season commenced, and we had earnings reports coming out showing earnings report after earnings report were stronger than the expected results, and investors responded in kind, both emotionally and irrationally, in my opinion, by investing with that same old question in mind on whether or not this is a new market cycle. Now, the rallying was short-lived, as I shared it would be. Once Treasury yields showed that they surged, the 2-year jumped above the 10-year, the 2 years at 4.5%, the 10 years at 4.1%. Now, what you need to know about Treasury yields and that reading is once the 2-year pops above the 10, the curve inverts. And with that yield curve being inverted, it's one of the best indicators of a recession that sent a shockwave of reality to the market. Of course, a recession is not news that we want to hear about, and then we saw the market dip towards the end of last week. However, we need to continue to walk on a road of realistic expectations. Guys, without inflation coming down and the Federal Reserve actually pivoting and with more of a dovish take on fighting inflation, we're going to see the continuous market cycles, or rather this market volatility, if you will. And the next big date we have to look out for is November 2nd, the next FOMC meeting, where the Federal Reserve is going to meet to ultimately determine the next interest rate hike. Now, personally, I wouldn't be too surprised if the Federal Reserve jumped at another 75 basis point rate hike, but time will tell, and here we are now with the necessity to remain cautious and patient as investors. The greatest thing we can do right now is simply find high quality companies to invest into for the longer term that are recession proof, with strong management teams and are very well capitalized, that also maintain a very strong brand name. This leads me to the very first stock I want to break down today, Restaurant Brands International, ticker symbol QSR, which is a fast food holding company, with their most popular chain being Burger King and the smaller scale chains Tim Hortons, Popeyes, and Firehouse Subs. Now, since their founding as a holding company in 2014, Restaurant Brands has only managed to grow pretty steadily, which is reflected in that market capitalization of theirs, just sitting north of $17 billion. As we speak, their stock has maintained itself pretty well over the course of the year with market conditions as they are, with only a nominal decline of 4.4% on the year. From their peak of around $61 per share, they're now trading for around $55 per share. And as we face a recession that is seemingly impossible to avoid, Restaurant Brands, like a McDonald's, will be a company that is going to be here to stay. And of course, with their PE ratio coming in at 21.1, I don't really foresee it declining much more than that, but the safety I think is worth the premium. Now we can even see that being so with smart money actually investing millions of dollars into the position. We have Eagle Point with almost $1 billion and Bridgewater Associates at $46 million worth of a bet. But most important is seeing a clean balance sheet with assets fully covering liabilities when coupled with a brand itself. This is just a great investment in my opinion. Not to mention analysts foresee over 18% worth of upside potential with a target share price coming in at $66 per share. Now we're also talking about the ability to collect on a very reliable 3.93% dividend yield. Moving on to our second stock of the day, I want to talk about a real estate investment trust. It's a leading net lease solutions REIT and it's Realty Income, ticker symbol O. Now I have harped on this REIT for a long while and it can never really get enough attention in my opinion, especially when its stock share price has been sliding most recently from $74 per share to roughly $57 per share, making for a 16% change on the year. Now guys, real estate is the perfect hedge against inflation, and with inflation likely here to stay for some time, Realty Income is an investment to truly consider in my opinion. Now it was founded all the way back in 1969 and has amassed a portfolio of over 11,000 properties spanning across all 50 states, even overseas within the United Kingdom, Spain, as well as Puerto Rico. And if we were to take a more in-depth look underneath the hood of their real estate portfolio at their tenants, it only grants more confidence for me because I'm looking at clients like Walgreens, 7-Eleven, FedEx, Walmart, the Home Depot, just to name a handful. But it's the very fact that Realty Income is a net lease solutions REIT that actually excites me the most, given a net lease is essentially when the landlord, in this case Realty Income, leases out a property to a tenant with the tenant paying for all associated costs from property taxes to all the upkeep. Now talk about added security, it's built right into the leases themselves, all of which has allowed Realty Income to amass a $35.71 billion market capitalization. Now pulling up their financials, we can see another squeaky clean asset to liability ratio with $44 billion in total assets to just $17 billion in total liabilities. Better yet, however, is the recent hedge fund activity to which we see multiple hedge funds investing millions of dollars into the position, likely padding up their portfolios for protection against inflation and the looming recession. Now as a shareholder, I find Realty Income to be quite a thrill for the sake of being rewarded on a monthly basis with a dividend coming in at a 5.14% dividend yield. Now just holding on to Realty Income will also allow you to reap the benefits of the value of the stock share price itself, with predictions coming in at 23% worth of upside and a target share price at $71.21 per share. And last but certainly not least, investors, I want to go ahead and talk about a sin stock that I hardly ever talk about, but it's just too ripe for picking given the times that we're living in with stubbornly high inflation. We have Philip Morris, ticker symbol PM, which is one of the world's largest tobacco companies with their $134+ billion market capitalization as they sell their products in over 180 countries worldwide. Now, I'm not here to talk about ethics within investing. I'm here to talk about making money. After all, if we really want to talk about ethics, well, we can get to Coca-Cola, Pepsi, Tyson, and all the alike. I mean, they would just be as guilty in my opinion. Now, that's neither here nor there. So Philip Morris not only has a very powerful brand name with a healthy balance sheet, as we can see assets over 40 billion while debt is hovering around 24 billion. Philip Morris has a product that is just outright addictive and keeps people coming right on back. Now, in a recession, when times get tough, people are of course more stressed out, and of course they resort to, unfortunately, what kills them. And there you have it, added security with an investment through the thick and thin of literally any and all market conditions. However, at this time, Philip Morris is actually down on the year by nearly 6%, trading for $86 per share, with their PE ratio coming in much lower than their competitors at just 14.8. This is literally the time, if any, to consider sinning with Philip Morris. And if you won't be doing that, well, hedge funds are already doing it for you, pouring millions of dollars into the position with Philip Morris, perhaps just beating you right to the puff. And we're all now awaiting their share price to hit $105.25 per share. That's the target share price. That's about 21% worth of upside. But wait, of course, there's more when it comes to investing in Philip Morris. For the high inflationary times that we're in, shareholders are going to reap the benefit of a higher than average dividend yield, with Philip Morris's dividend yield coming in at 5.87%. And there you have it, investors. We have Restaurant Brands International, Terility Income, and Philip Morris, the 3 stocks that you may find worthy of an investment for our times and the market conditions that we're in. But please remember, I'm not a financial advisor, so before making any finalized investment decisions, you got to conduct your own due diligence. But now also remember, your support goes a long way. So if you've learned something new or you found this information useful, go ahead, tap on that thumbs up button for me. Most importantly, I'd love to know what you've currently been looking into. If you've been investing into any stocks lately, drop all those comments down below. And last but not least here, because I'm looking to obviously grow this channel, have you on the journey with me, go ahead and tap on that subscribe button as well. And now, until the next video, investors, I will see you all there.